Let's talk about speed. Speed, which is what their game is all about, simply increases the risk of liquidity, feast, and famine. So this, again, you're talking about markets that are much tighter, much deeper in terms of what we can see today versus 10 years ago. I can remember actually sending a bid offer into a trading pit to ask what was there, kind of a thing, and getting a nice wide spread made by some market maker, kind of a thing, as opposed to an electronic market that is exposed to the entire world. Okay, first off, is speed what it's all about?
No, I think. Because I'm on the technology side, I deal with latency and speed an ungodly amount. And even then, I realize that latency and speed is necessary but not sufficient. You can have all the latency and speed in the world that you want, but if you do not have fundamentally sound trading strategies, that speed gets you nowhere and in fact helps you lose money faster. So we need to keep that in mind when we're talking about speed, and every strategy is based on speed, and this isn't something new. The Rothschilds made a killing because they could send faster pigeons across the English Channel. There's this great book that a lot of young people in the industry read, True Confessions of a Stock Jobber, and it was written in the early 1900s. And in there's a paragraph about how he moved offices so that he could be in an office where the telegraph was closer to his broker. And so his message was taking a faster path. There are stories about people giving bicycles to their runners so that they could go faster down the street than somebody running could. Speed has always been part of it because every single trade can do better if it doesn't slip. So it's not necessarily like a weapon, as I've heard it talked to. It's a tool that can be used by every type of trading. And I think just because of the frequency with which positions are put on and taken off, it gets associated with high frequency trading more than other types of trading.
How do you make the pigeons faster?
I think we're actually kind of hitting the limit there, but that's pretty much, that's their entire 4-day conference is devoted to that, not 30 seconds in one panel.
Yeah,
so.
yeah.
But I'd go a step further though. I think not only is speed, only one piece of the puzzle, but I think speed is very good for the markets as a whole. Speed is an indication that the role of the professional traders is very competitive. We don't need to get faster in order to compete with retail investors or institutional investors. That's not what we're doing. We're not in competition with investors in the market. We're in competition with each other to be able to serve those investors, to be able to offer them better prices and better markets that really hold together. And that's why there's a need for speed. Beyond that, there's again, I always go back to the data. I'm a data guy. That's how we build our trading business. We look at data. That's how I think about the world, that if I can't test it, I'm sort of skeptical about it. But there have been numerous studies that have gone out and looked at what happens to market quality when you make the market faster. There was a study of the German stock market, Xetra, a few years ago. They upgraded their matching engine and it got milliseconds faster at the time. And not surprisingly for people who are in these markets, market quality improved across lots of dimensions in terms of bid-ask spreads and depth of liquidity and measures of price discovery. That kind of thing is really where the discussion should be based upon. It shouldn't be based on people's feelings that speed is somehow dangerous, or that somehow the world is going too fast for them or something like that. It really needs to come down to an understanding of what the data says and whether or not people are well served by the markets we have. And from everything I've seen, markets that get faster actually serve investors better.
Which one of you three guys is the fastest? All right, all right, go ahead, Don.
No, I think that what we see in some cases is some exchange matching engines are faster than others. And the result of that is that the exchange with the faster matching engine winds up with better quotes, with tighter markets, and higher market quality because the liquidity providers in that market have greater certainty of execution. the markets where there's a high standard deviation of matching times and the average matching time is greater winds up being a less certain place to trade. And so, when entering resting bids and offers, you have to give yourself a little bit more buffer. You need to demand a little bit more edge. And I think that, we know that anecdotally because we trade this stuff every day. So when I read quotes like this, I think, well, what would happen if you just put made everybody wait 5 seconds? The matching time needs to be slowed down. Every trade has to take 5 seconds to match. What would happen? Well, you would see bid-ask spreads widen out. So that there would be a clear increase in cost to end users.
Dean, when I first got into electronic trading, trading E-mini S&Ps at the CME, I remember hearing a statistic that the Globex could handle a whole 30 transactions per second. How much has that changed since then?
I don't know what the actual number of transactions per second that the match engine can handle, but obviously it's exploded. I mean, from our perspective in the regulatory world, right, just since 2006, we've gone from receiving 1 billion messages in our systems a month to receiving 5 billion messages a month, right? So, that's an indication of how much more activity these engines are handling, and certainly the turnaround times. If you look at a graph of the turnaround times on our match engine, they've come down dramatically over the years, and I think that you've seen that across the industry. But the one thing that I would just follow up on what Richard said is that there is another side to speed, right? From a risk perspective and from a regulatory perspective, right? Speed does change things, right? That liquidity that's in the marketplace can be consumed a lot more quickly, right? In that environment, you can have these transitory liquidity gaps where an order can, come in and move the market very violently if the liquidity isn't there. It really demands, right, that the market structures evolve along with that speed, and if they don't, right, there are dangers to the marketplace.
Okay, so now we have one of my favorite slides. We're going to talk about some of what Mr. Bart Chilton has to say. And again, it's just like CNBC, everything, is true. So Commissioner Chilton has said, recommended 4 rules. Testing for algorithms before they go live. You guys ever test an algorithm before you put it into a marketplace?
Yes.
Yes. Okay. And there's exchange facilities to be able to test that, so they see some of these things too, right? Mm-hmm. Regulators, I don't know. They don't necessarily have the capability to be able to do this kind of thing, right? So I don't know who he's asking to test this besides what's already in place. A pre-approval or accreditation process for, cheetah traders. I don't know, should you guys be licensed like floor brokers or FCMs or IBs or any of that kind of stuff? Should be identified? We're talking about hedge fund registration. There's family offices have to register, all kinds of things. Should principal traders have to register?
A lot of us are registered. A lot of us are registered broker-dealers. So there is the registrar. I've taken the 7, the 24, et cetera, et cetera. We've gone through all the things. We have a compliance office. More importantly, we have a QA office that tests every trade as much as we can, as tightly as we can. The thing to remember is we want to be compliant. We want the markets to function properly, and then also we don't want to lose our shirt. And this is our money we're investing. So we test everything much, much better than could ever be tested by a third party, because we have that fear that we could really mess up our own income. And so that fear backs our testing, and our testing is incredibly precise.
So should there be big pre-approval processes for new entrants to kind of keep them out, kind of thing, protective? No? Okay. Do any of your programs have kill switches?
Yes.
Yes.
I mean, in fact, one thing to talk about is the CME has had a lot of these requirements for a long time.
Yeah.
So not only do trading firms, members of the CME, required to have their kill switches, but if they're clearing through another clearing firm, the clearing firm needs to be able to access that clearing switch. So I think a lot of these safeguards are already in place.
Okay. If you had to pull the plug, could you pull the plug?
Yeah, and it's not like 2001 Space Odyssey. I'm sorry, Dave. I can't do that. No, I think I think this gets to sort of what is one of the fundamental fears, though, behind this discussion. It's this general idea that computers are taking over, and the story that there's Terminator or 2001 Space Odyssey or all these
Whopper.
robots and computers taking over the Whopper, with war games, right?
Yeah, right.
The taking over the world, that is a much better narrative. It's much more fun to tell. It's much more fun to read in the newspaper than what I think is the truth here, which is that, in this case, these are markets that are being traded by people using computers as relatively simple but effective and efficient tools in the market. And that, there is a lot of human oversight in the entire process, from the, algorithm creation to programming the computers, to managing risk, to managing compliance, and to operating the models in the market. I think people need to realize that there are some things that computers are better at than people. When it comes to routinely calculating figures millions of times a day based on data, yeah, you're going to want not people to try and do that on their head. You're going to want computers to do that. But this is not a complete surrender of human authority over trading. The human role is still very much present.
There is kind of a damned if you do, damned if you don't, though. There have been a lot of times where the markets have gone nuts and people have hit their kill switches. And then the next day the headline is, markets plummet because people pull liquidity. I think there's definitely times where we've seen kill switches been hit, and that's good. It's a good thing. It removes a lot of systemic risk. It's also important to remember that kill switches aren't like it's not like the Office Max easy button. You can't just anybody can walk by and hit it and everything's better. The thing to remember is that we all have kill switches, and those kill switches can actually be very detrimental to our P&L, but we have them anyway. Because if I'm completely killing all trading, I'm not covering my position. I'm not getting a hedge off. I'm actually pulling completely out of the market. And that is a decision that trading firms have made to their own detriment for the betterment of the market at times. And that's something that needs to be remembered about kill switches.
Okay. So is there any greater accountability than what you talked about in terms of your own your own net worth and income being at risk? Should HFT traders be accountable to some higher calling force?
Dean.
It's Dean.
Dean, they should be accountable to Dean.
Yeah, I think we all, we're active in these markets. We need well-regulated markets with integrity. We're not above regulation. We certainly welcome sort of thoughtful regulation, support a lot of the initiatives on better audit trails and better surveillance and whatnot. As firms that are very active in the markets, well-regulated, well-functioning markets with integrity are critical to us.
We've talked a little bit about some of the things that non-HFT people have seen in the markets where they're calling things predatory and all of that. Do you guys in the data see anything that makes you go, oh, that's wrong? That where you can see manipulation occurring or some malfeasance of some kind? In the pit, you saw the guy across the pit trading with his brother-in-law or, whatever, kind of a thing. What kind of transparency can we, can you see? Or what do you do with it? Call Dean, I know.
Yeah, I would say as market participants, we have a lot of transparency into the market. We can see, all the orders that are placed, and we can see all the trades that go up. We don't get any attribution, so we can't see, is it one trader who's doing something, or is it a bunch of traders interacting with each other doing something? So we've occasionally seen things that look very unusual to us and reported them to exchanges. It's pretty rare that something gets to that level where we feel a need to call up an exchange and say, hey, what's going on there? But I think where the most transparency is important is on the exchange side and on the regulatory side. If there's something unusual going on, The exchanges and regulators have complete audit trails with attribution, and it's very easy to call someone up, a trader up, and say, hey, why did you send those orders? So I think this is actually an easier market to police in many ways than manual markets of the past, where you had to try and capture what a particular look on someone's face or a particular gesture might have meant. This is really very unambiguous and relatively straightforward to police.
And I would just say, John, too, that although folks may think that there's more self-policing in a PID environment, I know from the phone calls that I receive that folks in the electronic market are very astute and watching what's going on. They're no less likely to call us about something that they see that strikes them as anomalous or concerning. And as Richard said, I mean, oftentimes, because you don't know what's behind it, what you think you're seeing is not, in fact, what's happening. But that does not, certainly doesn't preclude people from bringing issues of concern to our attention.
Yeah, I can remember more than one occasion calling Dean to express concern about some trade that we've seen in the marketplace. Not always, a high frequency related issue, but in some cases, orders that appeared to be prearranged, instances where it appears that somebody broke some kind of rule. So, I mean, that's certainly, we're strong proponents of a level playing field, of a marketplace in which everybody plays by the rules, because if there are people who are breaking the rules, we know that we're not going to break the rules. That puts us at a real disadvantage.
Are there algorithms that go wild? Algo's gone wild. I mean, that's one of Bart's big fears, that there's these algos that gone wild. And I'm trying to think, if the markets are so efficient and everything, wouldn't the 10 HFT programs out there in a market destroy one that had a little bit of a glitch in terms of what it was doing?
No.
Go ahead.
No, I mean, absolutely algorithms can go wild, right? It's a risk. And, again, it comes back to, what structures we have in place to protect the broader marketplace against those risks. So even in those situations where we have seen those occurrences, right, one, there is accountability for folks with respect to their compliance with the rules, but there are systemic things that are in place at the exchange level, and obviously all of these folks have things built into their algorithms to prevent them from going wild, right? So there's all kinds of checks and balances, and certainly there are times when those aren't sufficient. You have the exchange checks and balances as a backstop, and that serves to mitigate how bad the algorithm gone wild can get. But can it happen? Sure.
Have you guys ever hired a high frequency math guy who got a B? No. Okay. All right. So let's talk about the race to zero. Flash crashes, like car crashes, may become more severe the greater the velocity. The race to zero may have contributed to those abnormalities, adding liquidity during a monsoon and absorbing it during a drought. This fattens tail risk. Understanding and correcting those tail events is a systemic issue. It may call for new rules of the road for trading. Grit in the wheels, like grit on the roads, could help forestall the next crash. So this is, Don, your issue of 5 seconds. And you know what? There's all kinds of people out there that are calling for some kind of alternative type of auction process that has some kind of a time element built into it. I mean, it's funny. At Boca a couple of years ago, we had this professor, and he gave this great presentation about this great process, and I said, isn't that the LME market? And I mean, that's not exactly the high frequency trading, platform. So, I don't know, should there be grit in the wheels? Should there be some kind of a slowdown in this whole thing?
Yeah, I mean, everything that we see says that any kind of implemented slowdown is just going to cause markets to be wider. I think that will increase costs to end users. One of the ways of thinking about order placement is that every time you put an order in the book, you're essentially selling an option. You're selling an option on the market moving, the fair value of the market moving through your bid or through your offer. And so if you have a time constraint on your option, then you can think of the time component as, the part in the Black-Scholes model that helps you define the option value. And as we all know, the greater the time you put in your option pricing model, the greater the value of the option. So as that option value increases, the amount of edge that you need to demand increases. And so that's what causes bid-ask spreads to widen out as you impose greater time constraints on orders.
Yeah, I agree with Don. Minimum resting times and other types of intents to slow down the market by changing technology. I think those are sort of doomed to make the market function much less well for investors. You'll get wider spreads, you'll get less liquidity, you get more volatility, all the things that you're seemingly trying to solve for, you'll actually get the opposite of. On the other hand, though, I think there is one good point is this does talk about what the value of circuit breakers, and that type of sort of a common sense safeguard to make sure that volatility in a market is within well-known and understood constraints over very short periods of time, to make sure that there is an opportunity to manage risk and to replenish liquidity and all those things. Those make a lot of sense, and we've sort of strongly supported different modes of circuit breakers to help make markets function more appropriately during times of great excessive volatility. The CME's been a leader in thinking about a lot of those issues.
And that really is the grit in the wheels, right? I mean, whether it's protection points on market and stop orders, right? I mean, you put a market order in, and if you have a liquidity gap and you don't have those protection points in place, you obviously can have a very significant and disruptive move. I mean, in our E-mini contract, I think the protection points are 3 points. I mean, it's 1/4 of 1%, right? We have things like stop logic, right? So if you have these cascading stops, and again, there isn't the liquidity to support those execution, the market can pause from 5 to 20 seconds and allow that liquidity to replenish. I mean, you can build those kinds of things. I mean, there's a whole host of them. I mean, we have them in terms of price banding to protect from kind of fat finger price errors. We have maximum order quantity protections that prevent fat finger quantity errors. We have messaging throttles, that protect, against, an algorithm just sending in a tremendous number of messages. So that is the grit in the wheels, and that's a lot different than slowing down the whole market.
Right. So remember, slowing down the whole market, if that was something we went towards, making the entire market slower does not necessarily equate to safer. This analogy made me immediately think of my very first ever driver's ed class, and the teacher said, that most people, when they see a wreck happening in front of them, they hit the brakes. And he's like, I'm going to tell you right now, one of your greatest tools is that accelerator, because if you can get out of the way of a wreck faster, you're not going to be involved. And so we have to remember that speed is an important tool that can help us avoid situations. If everything is slowed down and you see a great deal of risk coming your way and you can't get out of the market, that could be very harmful to systemic risk, because you could have a lot of market participants who aren't there tomorrow. And so we need to remember that speed and risk don't go hand in hand. It's not causation.
Okay. Is high-speed computer trading killing investing? And now this is one that troubles me a lot, because John Najarian I know and he does not like high-frequency trading. He calls it out all the time on CNBC, and he says all they do is push out any other potential real liquidity provider with their fake liquidity. He's of the same lineage, Don. I mean, he stood in the pits and traded. Where did he get off the rails on this?
I haven't spoken with him for quite a few years. So
You're holding it against him? Is that what the deal is?
No, that's not it at all. But I mean, one of the things that we've seen as these markets have evolved and gotten more efficient is that some people who had certain ways of making money historically are no longer able to make money in those same ways. I mean, markets are Darwinian, and so there are certainly there are certainly some people who view this evolution in a very negative light. I don't know if he's in that category or not, but that's one conceivable answer.
Okay. What is fake liquidity?
Yeah, I'm always perplexed by that because, in a trading pit, you can talk about fake liquidity, right? Somebody who says, I'm bid on 1,000, and then you go to sell them 1,000, and they say, I was just joking. That's fake liquidity. If you if you enter an order on a screen to buy 1,000, it's there, and if somebody else sends an order in to hit it, they're going to be filled. So that's real liquidity. There's nothing fake about it. Sometimes people just leave their orders in for very short periods of time, but it's still liquidity. There's nothing fake about it.
Yeah.
I think it also sort of gets to this idea that somehow humans can't interact with these markets anymore. That there's just so many computers out there that a human can't sit in front of their Ameritrade account and enter an order and get a fill. And I think that that's just demonstrably not true. I mean, you can look at the markets today, and yes, there may be lots of quotes in the market, and maybe prices adjust relatively frequently, and maybe sizes that are available on the inside move around real quickly. But it's never been a better time to be a retail investor in any of these markets. The spreads are tiny. You can send an order in, you're going to get filled almost instantaneously at very low cost. And this idea that somehow what you see on the screen isn't real, I think is just not borne out at all by the experience of people trading in these markets or by any of the data about how these markets move and function.
In Boy Scouts we have fake liquidity. It's called powdered water, and you just add water to it in order to. Sorry. All right. The next one. HFT firms indulge in dark arts like placing spoof orders to sell shares at attractive prices. These are designed to scare gullible traders into offloading their own shares, at which point HFT investors withdraw their own spoof orders and snap up the real ones. All right, so today we had a couple of headlines. One that came out of Reuters about the FSA that froze the assets of some firms that they said manipulated share prices on the LSE and other trading platforms. Okay, and what they said they did was they did so-called layering, which refers to traders entering multiple orders which are canceled almost immediately, creating misleading impressions as to the supply and demand for shares. Genuine orders are then placed to exploit the shift in prices engineered by layering. So this seemingly is a big problem here. You got the FSA saying, hey, you can't do that, okay? Is spoofing, is there spoofing? What is spoofing? What role does it play? Did you spoof in the pit? I don't know.
Well, I mean, I'll take that from a regulatory perspective, and I think part of this gets back to your last slide with respect to what constitutes fake liquidity, right? So, from my perspective, spoofing is a situation where you're entering an order that you truly do not intend to trade, right? And your objective is to deceive other market participants and then to exploit that deception. And there certainly are circumstances where people may, choose to try that strategy. In terms of the issue of is it rampant in our markets or our industry, I think the answer is unequivocally no. Right, because even the case that you're referring to, this is something that is quite rare, right? There are a lot of legitimate reasons for layering orders in the book, right? And as Don said, when you put an order in the book, it is subject to being executed. But there are certain types of strategies, right, that people could employ that we would think were not constructive, for a fair and efficient marketplace. So can those kinds of things happen? Yes. Are they limited to high-frequency traders? No. And to the extent that it's identified and that it's a problem, people are accountable for it.
I think sort of an interesting point about all of this is there have now been at least 3 cases that I'm aware of where people have been charged with spoofing. And in all of those cases that I'm familiar with, it was not a high-frequency trading strategy at all. It was a manual strategy done by keyboard traders. And generally, my understanding is that the point of this is to trick high-frequency traders. So not only were high-frequency traders not the perpetrators, but in many instances, they were the intended victims.
Right.
Gullible high-frequency traders, no doubt. So, isn't part of trading? Isn't it kind of like game theory? Isn't it? Aren't there all kinds of different things you do in order to kind of deceive the other players? I mean, I know guys that would walk into a trading pit and had millions of bushels to buy, and the first thing they do is start to sell in order to attract enough selling that they could buy into, kind of thing. I mean, that was a strategy. Okay, so and there's guys that there's stories about guys that used to walk by the trading pit and the market would drop 5 ticks just because the market knew that they were going to come in or thought that they were going to come in and do something, and so I mean, you see those things, isn't that part of all part of the game of trading, is deceiving the other players into doing something. There's all kinds of different things where people will try to react to different chart patterns or something like that to encourage certain types of traders to take certain actions based upon what they think they'll do with, reading a specific charting pattern or whatever. Is there a certain amount of this that is just normal part of the game, normal part of the market?
I think that that's one of the tricky things about concepts like spoofing, is that obviously to really know whether somebody was spoofing or not, you need to get into the thought police business, and so it's difficult to know where to draw the line. But I think that it sounds like in the FSA cases that here's an example of a firm that allegedly engaged in a repeated pattern of placing very large bids, placing very small offers, pull their large bids so that after they get filled on their offer, and then use the opposite to kind of scalp out of their trade. So I think that where somebody engages in this repeated pattern of essentially signaling to the market an intention that's different than what they actually have. That's on one side of the line. But you're right, there are some instances where maybe if somebody needs to execute a large order, they don't just go into the market and say, I need to buy 1,000, because the market will run away from them. Maybe they only buy 50 at a time. And so obviously, somebody might argue that they're deceiving the market because they're not telling the market how many they have to buy. But I think that that's pretty clearly on the other side of the line, where you have a right or obligation, if it's somebody else's order, to do the best job you can executing the order. So.
Okay, so these guys, they had actually a name for their strategy. It was called the Da Vinci Invest Code. Okay, John Nigerian has talked about high-frequency trading, and this one that he has a particular problem one that they've named the Predator. Okay, and we've got the banks with all their different strategies, the Raptors, and all this kind of stuff. Do you guys have funny names for your strategies?
We have a trade called Funshine.
Funshine?
Yeah. Which is pretty benign as you can get.
Yeah. Yeah. So you don't have any like barely annoying, really fast, cancel, replace, something programs? No? Okay, all right. See, that's one of the things. You got the showbiz side of it that's going, there's this predator out there, you know? And I mean, there was a story, there was a spoofing one, Dean, in the E-minis from years ago, where there was the Russian that came in and that was spoofing. And there was, there's always a great story with these things. Do you guys have names at the CME for any of these things that you identify?
No.
No?
No, but the part of what you just brought up, I mean, one of the examples during the recent volatility that we had in the markets, there were some stories, out in the press about the fact that, the E-mini book depth had declined during this period, and it was due to these rogue disruptive algorithms, right? And again, that information or misinformation, right, gets out in the press, and people eat it up. I received many phone calls, right, about this press report, but in the end, right, I mean, volatility exploded during these weeks. Book depth declined, right? I mean, it's something that happens all the time. Volatility goes down since then, the book depth goes up, right? But people attribute it to, nefarious activity.
Is there a formula here?
Yeah, well, back to the same formula, actually.
Yeah.
As volatility goes up, obviously the value of the option increases, and therefore you need to demand more edge. And so you probably are placing orders at wider intervals, which causes the book size to decline. And also people, generally want to take a constant amount of risk. As volatility goes up, it means that the risk on one contract is increased, and therefore they trade fewer contracts. It's fairly benign, simple stuff.
Quant stuff it just doesn't have a good story to it. I mean, you guys...
Doesn't play well in Hollywood.
It doesn't play well in Hollywood, God, I used to have strategies that had names like the ham sandwich and, all kinds of great stuff.